we thought we were kind of like getting out of that, and then it kicked back up again. It's been this kind of like wave of delinquency. And we've also seen in the last year is so much price sensitivity to other apartment buildings in the area where we never really had as much as that before. If someone lowers their rent $250 or offers a free month, that greatly affects us. And so we have to really be on top of what our competition is charging, because people will leave to save just a few dollars.
All right, welcome back to the Live 100 podcast. I'm Jason Yarusi. Very excited for my guest today, Gary Lipsky. And Gary has been on the show with us in the past. It's actually been a few years now. He was on one of our other podcasts, Multifamily Live. And so it's good to connect again with you today. Gary, how you been?
Good, man. Great to be back.
Yeah, it's great to have you. And so he has a lot going on. He's always been very active out there in the market. He is the president and CEO of Break of Day Capital, is a multifamily operator, over 1,700 units, national speaker, best-selling author, real estate entrepreneur. His company has won the best real estate syndication company by the AAOA in 2022, recognized by the 25th fastest growing real estate company by Inc. magazine. He's the host of the Real Estate Investor podcast, where he interviews experts that educate investors really on all the things he does. Is best-in-class operator, invests smart, and he's built several companies, co-produced 3 independent films. I didn't know that. Started a nonprofit organization for underprivileged children. And, Gary, it's great to be back, man. And so we talked 3 years ago, right? And 3 years ago, we were just in this precipice where the market was interesting, market was hot. There was a lot of things happening, but there was some bubbling of changes, right? And now we've had just all different turns, left, right, up, down, just out there in the market. We've seen things really explode. But now here we are today, where we see rates still elevated, right? We hope we see some rate relief, but we've been hoping, right, for what feels like 18 months for some rate relief. Yet you're starting to see a lot of activity out there in the market. So talk to us about your company today, right? And it's been 3 years, about where you're positioned today and what you're working on right now.
Things have changed a lot. You've, during that time, certainly been hit with higher delinquency, more concessions. You're not really doing unit upgrades because you're not getting the rent bumps. You're having to spend a lot more time on asset management than you ever had to. And people that aren't good in asset management are really paying a price for that. And certainly you've got, maybe if you bought in 2022, maybe some over-leveraged deals, interest rates, really hurting you. Running those properties are much, much harder than beautiful days of like 2015 to 2022. Times have definitely changed. You're seeing really good deals out there because they're 25 to 30% below market of what you would have paid in 2022, 25% maybe below replacement value. Great opportunity, but certainly a lot tougher to raise capital because some people have had capital calls, some people's deals have gone under. There's a lack of deal flow. Money is kind of stuck in deals. And investors are a little wary of investing right now when there's so much opportunity right now to be had.
How do you see those deals working out where right now there's a lot of deals that are over-leveraged, right? That are facing higher interest rates? What's some of the crystal ball philosophy for some of those people that maybe are strong with asset management or have found their way that they've been forced to become strong in asset management due to just the way the deals are run?
Yeah, so definitely some deals aren't going to make it even still. But if you could push on a little bit longer I think everyone was trying to get to 2025, but now it really looks like 2026, 2027. If you can hang on to then, maybe for some of those deals, you do okay. Some of those deals, maybe you get back what you invested in. And some of those deals, maybe you lose 50%. There's still a big unknown on a lot of those deals. But like you said, if you have a really good operator, then you're going to survive. And, we'll see how it plays out. But obviously bonus depreciation coming back, which is huge. You're going to see a lot of money coming in because of that. We're going to finally get some rate cuts, whether it's September, October, November, and then obviously Trump's going to replace Jay Powell. He's a big proponent of rate cuts. They want rate cuts because the government has trillions and trillions of dollars of debt they need to refinance, and certainly they don't want to pay twice as much as they were paying. He's going to be pushing for rate cuts. So doesn't matter what side of the political aisle you're on. This is coming, and it's going to be really good for real estate.
How have you been positioning your company now, noting the opportunity that's coming around? Has your business plan adjusted, changed, pivoted in some dramatic way?
Yeah, we're still focused. We've done all of our deals in Arizona. We love the Southwest. We love it's very landlord friendly, above average population growth, job diversity. Those are the markets within this small radius that we like. We're not chasing deals all over the country. So our focus still remains on multifamily. I think we were doing more value add deals. So 70s product, maybe early's product. And the last two deals we did have been in 1999. We're in a best and final on a 2001 product. So we're looking for that newer. I think there's where the cap rates are right now. That's where the best opportunities lie, for at least for the markets that we're looking in, and nice cash flow. That cash flow is so important to investors right now, and certainly to us as well. That's our play. Less of the big lift that we were doing probably in the beginning of our company.
For 2025 has been interesting because although there hadn't been a dramatic change, we've seen a lot more activity or just positive momentum from a buyer side, right? You saw the last few years where just wasn't out. You mentioned best and final here, meaning that you're with a number of different potential buyers that are competing for the same deal, that have all found this deal that attractive that you want to move to that next step. And, what do you think has been that big narrative change and just perception on what has brought more buyers back into the market?
Well, I think it's twofold. You've got some sellers that are more realistic in their expectations, because you're looking at 2023, 2024. Sellers wanted that 2022 money, and that wasn't happening. As they are forced to sell, or they've done well, they bought early, and now that their 5 years is up, they're looking to exit, maybe sell a deal to take some of that money to help them with some of their other deals. Expectation has definitely come down, and we're still, even our number is still probably 2 million off from what the broker whispered, but that's where our number, we're still in the hunt. And that's how I've seen definitely more deals over the last couple of years where the brokers, let's say looking for 40 million, we come in at 36, and maybe they are realistic based on all the bids that come in, or however few that come in. The seller supposedly is going to sell, so we'll see if someone goes above our number, or somewhere where we're close to, and we'll figure it out. But yeah, I mean, we stay true to our underwriting. We're not going to chase a deal. We never have. It just doesn't make sense. Even though we see an upswing coming, we're gonna win some, we're gonna lose a lot. How it's always been.
How are you looking at the lending environment? Because that's been the other interesting piece here, is just trying to pair the right debt with your business plan today, especially two parts, right? One, just getting a loan that fits well, right, for the business plan. But two, just forecasting where rates may be in the next 18 to 36 months, and making sure that you're not putting yourself in a bad position, being stuck with a loan that's hard to use, competitive to the market in those days.
Yeah, the last two deals, we used a life co company. So it was a little higher than agency debt. However, very little fees going into the deal, and really no prepayment penalty coming out after the first 2 years. So it gave us a lot of flexibility. We can refi into much lower interest rate deal if we wanted to. We can sell if we want to. It gives us that flexibility, and it was worth that maybe extra 50 bips that we would have paid if we went agency debt. You're obviously getting much lower leverage than before. So maybe 63%, I think the last two deals we did. So you have to raise more money, which makes it harder. So we're not looking as much of the really bigger deals where we might have done before, where we feel like we could still raise money. And I think certainly with us and other people I know, you're raising capital after you close the deal. It's not like, whereas, back in 2021, even beginning of 2022, you're raised in a week. Here, we're doing it maybe a month after, even 2 months after, and having whether you borrow money or, you have some pref, whatever that you have on the side to help get you through closing. And then, you're going to raise, money's going to still drip in. There's just a lack of urgency on investors' side. There's not FOMO, which, they might have had previously.
How has the conversations adapted with investors, right? And noting that we've seen in our part, right, there's still people that are actively wanting to take part in investing in multifamily, right? The space, although there's been challenges, is still a fantastic space. But just like anything, when there's blood in the water in many aspects, or people are hurting, there's less people available, right? So how has the conversations changed or pivoted?
Yeah, I think you have two oceans. You've got the red ocean, which is all the people that have been investing in multifamily deals, and they have multiple deals they're struggling with right now. They have less capital. They're a little bit wary. They may think about it. Whereas the other, blue ocean, where maybe they're not heavily invested in multifamily deals, maybe it's some Bitcoin, some stock markets, and tech, they're more willing to come in and not, have that baggage from the industry. And quite honestly, it's only a small fraction of deals that have really struggled. But within that kind of like social media world, it just seems so much bigger than it really is, that a bigger percentage of deals struggling. It's two different conversations depending upon where their portfolio lie, whether it's heavy in multifamily or heavy in traditional investments.
Yeah, and social media is twofold, right? Because if someone's invested in 10 deals, they're talking about the one bad deal they have, and then the other 9 they're not really talking about, right? So I could see that on that front, and that can sour someone's taste, right? Is especially if they got in and started investing in 21 or 22, they've missed some of the upswing that a lot of us really were able to see throughout the years prior that brought us into that. Are you doing anything different in terms of your investor base right now, or how you're reaching out, or how you're approaching investors?
Yeah, we're doing a lot of webinars, probably every 3 to 4 weeks, trying to provide educational content. In September, I came out with a book called Invest Smart, Spotting Red Flags in Real Estate Syndication. So trying to educate investors on what to look for before they're investing in a deal so that they can make better decisions. Certainly, I've made some bad decisions as an LP investing in other people's deals, and wanted to share that knowledge. And that's really important, because if people are educated, they're going to be investing with the right people versus the wrong people. And it's going to weed out the ones that maybe were just came into the business for a money grab, they thought they could make a quick buck without doing the hard work of really educating themselves. This is a business. Every property you own should be run like a business. And if you haven't, you're going to struggle. It's not easy times where you buy a property, you raise rents $100, $150, and you're going to double investors' money in 3-4 years. This is a lot of hard work, managing your on-site team and getting the best out of them, and managing your cash flow, managing your own team as well. It is a business, and I think a lot of people have figured that out in the last couple of years.
Yeah, there's less room for just errors to be washed under by just valuations running up. And so right now, and everything's hitting, right? And you're seeing tenants, depending on your asset class, many tenants are struggling more than they have in the past, just based on the run up in cost, right? Because their paycheck hasn't increased, right? If they're working at Walmart, it's not like they've doubled it while they've maybe seen their grocery bill double. And so they've seen that, and they have to pick, they have that certain bucket where they're saying, okay, I have rent, you got my car payment, you got my insurance, you got my food bill, got my, kids, whatever. And now they're trying to juggle where it is. And so you see some of that softening here where delinquencies across the board, although you have the staying power, right? The bonus you've had is that tenants have not moved, right? We usually are like 50-50, and we've seen it like 60-40, even 65-35, where tenants are staying longer, which is great, right? Because you don't have the extra turn cost. But in the same front, you're seeing that also happen with them having more delinquency.
Yeah, we're definitely, we thought we were kind of like getting out of that, and then it kicked back up again. It's been this kind of like wave of delinquency. And we've also seen in the last year is so much price sensitivity to other apartment buildings in the area, where we never really had as much as that before. If someone lowers their rent $250 or offers a free month, that greatly affects us. And so we have to really be on top of what our competition is charging, because people will leave to save just a few dollars.
Yeah, Nashville was very interesting. deals there, and we had one deal. We really hitting our pro forma rents, but we had to regress because there was class A, right? And we're like we'll say class C building, but like a class B, really tenant based. But we had to really pull back our rates because the class A came on in such a strong fashion with how many units came on that they started putting out 3 to 4 months of free rent, right? And then that starts stretching, you start seeing that combo into the market. Now we finally have seen absorption go back positive, right? We had about really like 16 months of negative absorption. What that does is it softens rates. We've finally seen that back, so we're pushing rates again, and that's good to see. But it's very secular because we're 30 miles from there in another market where none of that has happened, and we've been pushing rates the entire time, have not pulled back at all, right? So it's very, very, you have to be really hands-on to what's happening with your competitors. But it's not as secular before where like your class A's were just doing their own thing and your class C's now it's literally all combined. If class A's are pulling back in a big way, it really hammers down to you because tenants will stretch. You'll be like, oh yeah, I can figure that out for whatever it is. I got 4 months to not pay rent, and I'll get in there, and by the time at 8, I'll move, right? Now we're seeing that happen because they're getting into their renewals, and now they're like, oh, I can't, and they're trying to push rates again. So always interesting on the markets, but you really do have to, it's always neighborhood specific as much as you think and want it to not be, right? You have to be really hammered in on what's happening street to street. And you have to know your comps in and out and make sure your comps are actually true comps. I see a lot of times where people falter because they'll pull comps that really aren't a true comparison comp. And that will be where they'll try to stretch your rents. And that's where usually things fall off. That property stands alone for its own unique avatar and its own unique tenant base. And then they see your property and be like, oh, it's nowhere near that property. So you're not going to get those rates. And where before it maybe was able to be washed away by some people because you had the valuation run up, right? And where cap rate compression and that hit it, where now you're seeing it that you have this combination where you need the rents, you need to stay occupied compared to where the market is. So you have to force the rents to where they truly need to be.
Yeah, you got to find ways for that extra income, whether it's adding, like VIP parking spots, just creating a spot near their apartment and charging $25, $30. It's not much, but if you find different ways, cable, Wi-Fi, different ways to get a little bit more income. Certainly water savings has been huge for us at all of our properties, but always trying to tweak little things to find an extra $5,000 a year income here, 10,000 there, 25 there, because expenses have gone up, and it's a battle to get your NOI up.
For your book, you talked about some of the red flags for listeners. What are some things that prove true? Because I'm sure it relates to multifamily, but it's probably from investing in general, it can be very helpful.
Yeah. So one of the mistakes I made, and I see a lot of people make, is, someone puts out like 25% IRR, and they're like, all right, well, maybe if they don't hit 25, they'll hit 20. And so I'm going to invest with that person without really doing your due diligence. Like a friend recommended this deal to me, and I relied on their due diligence. I didn't do much due diligence. I'm like, all right, he's invested with this person. He recommends him. I'll invest with him. But I don't know how much due diligence he did on the person. And I was chasing an IRR. Got to do your own due diligence and don't chase IRR. It's the ones that, are going for the 14, the 15% IRR, like the established operators that aren't trying to make sure everything is going to go perfectly, because I didn't hit the 20% IRR with this person. I lost pretty much all my money. They were in over their heads, and I would have been able to see it if I really spent time not jumping into a deal and seeing his infrastructure on his team, because he was taking on way too many projects, and he didn't have the team to support that. And
was it project on a property, or was it multiple properties? Or was it just projects taken on just on this one property?
It was multiple developments in LA, and development deals are a lot more risk as well, because we ran into COVID, and obviously things took a lot longer. He's running up costs. He didn't have a good support team. He had some family issues, and all this was affecting him. And instead of kind of getting out of the way, he got in our way, and then just sunk the some deals, unfortunately. Not the only one, that bad investment that I've made, but obviously, so number one is the jockey. You're really investing in the jockey, not the deal, because a good jockey, a good operator, has gone through market cycles, has a good team, usually has invested in the deal, and hopefully some of his other team members have too. So they're really alignment really good there. you want to look for someone that has been doing it in the same market for a while and not a new market. And if it's a new market, what other partners do they have, so they understand it, or have they done years of research on that and on that market, so that you know that they're just not chasing shiny object. Oh, I heard this market's good, I'm going to buy this deal. I don't really know it. And I've seen so many people do that in real estate. They move from one thing to the next without gaining that expertise. And it's very, very dangerous to be investing with that person. And hey, maybe they get lucky. Maybe they're super sharp. Percentage wise, it's the ones that are operating in the same markets for a while. Those are the ones that are going to, consistently do better than someone chasing deals all over the place.
Yeah, 100%. The market thing always catches me by surprise when people jump markets, because you have to have a whole infrastructure built up. It's like, just imagine you live somewhere and all of a sudden you move to a new market. You would do research, like, okay, like what's the schools like what's the supermarkets like, right? Like, it's going to be different, just inherently going to be different. Having the same exact business plan and trying to put it into a different market, into a different state. Sure, there might be some similarities, but there's a different focus, different marketing needs, different tenant base, different way that you're going to need to hire employees, different ways that you run your business, right? If you're in multiple markets, say you're just in 10 different markets with one standalone property, you just don't have the flow of resources that you have available if you're just comboed in the one market, right? You don't have, oh, I need this guy, right? Well, you've had 10 other properties, so you know where that guy comes from, right? Where in that part, you have to start all over. As much as you're not starting over in terms of you've done it in the past, you're still starting over with all the relationships you need to build.
Yeah, and you want to have those data points that you've been studying a market for a year or two, so you know what a good deal is and what a bad deal is. Because a broker is going to sell you, he'll sell you his mother if he's going to make a commission on it, like they are vicious. So you got to have those data points. You got to be looking at these deals for a while before you jump into a market. Not like, hey, a broker called me, I'm going to jump in, cold.
That's awesome. Any other red flags we need to look out for?
On the deal side, certainly leverage. What is the loan? Like we talked earlier, like, does the debt match the business plan of the deal? If it's going to be a quick in and out, you don't want 7-year, 10-year debt where your prepayment penalty is going to be massive. So maybe Lifeco or bridge, but if you're going to do bridge, make sure you've got a rate cap. Leverage is very important. If are they putting pref and mezz on there? What are the terms? You really got to understand the whole capital stack for an investor. If they're 85% levered, maybe 70% LTV and then 50% mezz or pref, and you're 15% left behind all these people, then you really got to understand, what does that look like for you? What is the break-even point on the property as far as occupancy? Because if it's too high, it's only the mezz or the pref and the lender that's going to get their money back, and you're going to be screwed. So really understand that. I think a lot of investors were not really paying attention to that. They're just focused, like I said, on the IRR or AAR, maybe the bonus depreciation, and not focusing on, what do the returns look like? Is a European waterfall or an American waterfall? And an American waterfall, they get back their money first versus the operator getting his piece of the pie. So there's a lot of different things that they should be looking for. And I think investors now are a little bit more sophisticated and not just jumping in because someone had a strong social media presence.
That's fair. Gary, it's always enlightening to talk to you, man. So tell me, where should people come find more about you, what you're doing, just open deals, what you're working on, the webinars? Where's the best way to find you?
Yeah, go to breakofdaycapital.com and you could see our social media, sign up for our newsletter, get deals. Everything is there. And you could set up a meeting, download some. We have investor resources as well.
That's awesome. Gary, thank you so much for being on the show. For everyone listening today, this is a very valuable lesson on all the things of why multifamily is great, but also some of the risks. And hopefully this has given you all the provisions you need to be able to look actively about what's happening in the multifamily space, whether you're an active operator or you're looking to invest. Go talk to Gary. Go talk with his team. You'll learn more about what they're doing. They have some great things they've been working on in the past, all the way now into the future with the great things coming up. Thank you so much for listening. This is the Live and Win Your Podcast. I'm Jason Yarusi. Let's do this.